So what was intriguing to me is long ago I debated George Selgin at the Soho Forum on this issue of does fractional reserve banking cause the business cycle or lead to economic instability, something like that was the resolution. And so I thought, this is unassailable. How could anybody dispute that? And in his work, though, the way Selgin tries to answer that objection, he said, no. With fractional reserve banking, again, as long as it's not subsidized by the government with FDIC and lender of last resort, central banks and things like that. But if it's just genuine private sector, the banks can do whatever they want. It's just if they expand too much, if the reserve ratios are too low and they get caught, then, they go under. So Selgin's for contract enforcement, but he's saying as long as they can get away with it and their customers are happy and nothing bad happens, they get my blessing, right? And that's economically productive. And so specifically what he said is if a bank engages in fractional reserve banking, and he agrees interest rates would drop to other things equal to get those extra loans out the door. He says there is saving though, right? So that explains why the falling interest rate is correct. And he says because an individual who holds a banknote is thereby granting a loan to the bank that issued it, right? And so here, don't think of it electronically. It's just easier to think of it in terms of paper notes. But the idea is think of a world where there's gold coins as the money. And the way banks work is people deposit their gold coins in the vault, and then the bank gives them, rectangular paper notes that say the bearer of this note can go to any of our branches and get 1 ounce of gold coin or 10 gold coin ounces, things like that. And then those notes can circulate in the community at par with the actual specie, the actual metal, money. Okay? And so if it's 100% reserves, it's just a matter of convenience, right? The total stock of money hasn't increased. Some people don't want to be carrying around a bunch of heavy coins. They put them for safekeeping purposes with the bankers, and then they get convenient notes of various denominations that they can, have in their wallet, and people don't realize how much money they have on them, that kind of stuff. But again, as long as each note circulating in the community is backed up 100% by gold now safely in a vault somewhere, that doesn't really cause economic distortions, right? It doesn't expand the money supply. The interest rate doesn't change just because of that. But now what if the banks, okay. And so, but Selgin's saying a person who, let's say there's a guy, he gets paid 100 notes from his employer and he only spends 80 of them. And so he adds 20 notes to his cash balances. Selgin wants to say that guy is saving, right? He could demand, the money from the bank, or he could go spend it, but instead he's saving it. So Selgin is saying the act of someone holding a banknote is in effect granting a loan to the bank. And another way that Selgin views it is he says, yes, if you go and turn your gold coins over to the bank and they give you notes in exchange, it's like you're making a very short-term loan to them, an instantly callable loan. And that note is like, the legal document showing that, yes, I can call this, I lent 1 ounce of gold to the bank in the form of that coin that I gave them. They gave me this piece of paper, and this paper legally entitles me to call the loan and get my coin back, or a coin back at any time, right? And so that's the sense in which Selgin thinks people holding these paper notes, these bank notes, are thereby lending money to the bank effectively. So that's why he's saying, so in a fractional reserve free banking system, which is the term they use, free banking, when the banks issue more notes by making loans to people, as long as the community ultimately adds those notes to their cash balances and they don't, find their way back to the banks for redemption, then the banks are fine, right? And in terms of the individual banks' constraints, they would, other things equal, want to issue more notes charging interest as long as they thought they could get away with it and the gold coins in their vault wouldn't go to zero. And so that's kind of what's going to guide them. They're going to say how much, given the community and their preferences and their willingness to add more of our notes to their cash balances, can we lend more and more with our given stockpile of coins in the vault? Or, can our reserve ratio get lower and lower? At what point on the margin would the bank say, nah, I don't think we should lend more. I don't think we should print up more notes and lend them out to people without having more coins in the vault to kind of back them up as our reserve. On the margin, they would stop when they would realize, at this point, I think we've created enough notes that eventually will find their way into various people's cash balances, that if we tried to print more, nobody in the community right now wants to hold more of our notes. We've kind of saturated that. And so if you could get someone to borrow more, no problem. But when they spent it, eventually it would soon reach somebody's hands who would say, I don't want to hold on to this. I'm going to present it to the bank that issued it. Or they would deposit it at their own bank, and then in clearinghouse operations, it would come back to the issuing bank, right? So that's kind of the check on an individual bank in a free banking model, okay? So again, Selgin is saying, it's fine. It's not distortionary. If they're correct in their entrepreneurial judgment and they issue more notes, pushing down their reserve ratio, right? Because they've only got the same stockpile of gold coins in the vault. We're just presupposing they're just printing more notes and lending them out into the community for a given stockpile of coins in the vault. And then nothing bad happens, and there's a new equilibrium, and those notes all find their way into various people's possessions, and they just add it to their cash balances. And now those notes are held in the community, serving as a substitute for money. Well, then that community, the holders of those notes are granting credit to the bank in Selgin's framework. And so it's not artificial credit expansion, that it's not that the bank is lending more than there's genuine saving. They're saying, no, the people who are holding the notes in the very act of doing so are lending to the bank. So it all matches, right? Okay, so very quickly, let me just explain to you why that doesn't work. Right, so it's very clever, right? Again, he's not ignoring the objection; he's trying to meet it head on. So at first, I was like, "Oh, that's interesting, that's clever," but when you think it through, it doesn't work. All right, and here's why. Okay, start with a simple case. Somebody comes up with 100 ounces of gold, like 100 coins, 1 ounce each, gives them to the bank, and the bank then gives them the 100 notes. So there, if you want, you can say that the person lent the money to the bank, and then the bank issued the notes to the person. Okay, I don't have a problem with that. I don't think that's what's going on economically, because the person thinks those things are spendable. But if you wanted to say that's a loan, okay. But now when that person goes around and spends the money, that's not new granting of credit to the bank, right? If that person goes and spends 20 of those notes, and somebody else voluntarily adds those notes to his cash balances and doesn't present them to the original bank for redemption, and just walks around now with that 20 in his cash balance, you can say that second person effectively lent the bank 20, if you want to talk like that, but then by the same token, the first person dissaved by 20, right? By him getting rid of the note, showing I don't want to hold this, he withdrew his credit, okay? So there was the community per se, just by rearranging the notes, is not granting additional credit to the bank. I hope everybody agrees with that. I think Selgin would agree with that too, okay? And so now the question is, okay, but thus far, a Rothbardian wouldn't have a problem with that. Rothbardians don't have a problem with 100% reserve banking. If someone comes and gives 100 gold coins to the bank, and they give him 100 notes that say the bearer of this note, can turn this in at any branch and get 1 gold coin. If that's all the bank did, and so at any given moment, all the notes in the community correspond 100% to coins in the vault, that's fine. That's not distortionary. And again, I think it's a little bit weird, but if you want to say that original depositor lent 100 gold coins to the bank, okay, fine. But now the question is, given that now the bank prints up an additional, let's say, 50 notes, Let's keep the number simple. Let's say they print up additional 100 notes, right? So it brings the reserve ratio down to 50%. Otherwise, the arithmetic's going to get tricky, right? So there have been no new deposits. Nobody else brought in actual gold coins. They've still got the 100 gold coins in the vault. There's still the original 100 notes that are out there circulating in the community. And you can say with each transaction, one person dissaved and the other person saved, and they cancel out. So the total gross saving in the community or net saving in the community is still the same. Okay. But now the bank prints up an additional 100 notes with no new deposits of gold coins, and then finds somebody and says, hey, do you want to borrow this from us at 3%? And the person says, okay. So we're going to give these 100 notes right now. You sign your name. A year from now, you owe us 103 ounces of gold. You can pay us in notes or you can pay us in coin. But a year from now, you agree you owe us 103? And the person says, yes. Okay. So now that person goes out. So that in order to do that transaction, interest rates, other things equal, have to be lower than they were the week before, right? Because before, presumably, the interest rate is what balanced the quantity demanded and supplied of loanable funds. So now if they want to issue a new 100 ounces worth of loans, the bank has to lower rates below what the market rate was. So the Rothbardian critique is you're pushing rates lower than the time, what corresponds to time preference. The community hasn't saved more, and yet now this bank is granting a new loan of 100 ounces. Where'd that come from? Nobody saved it. And Selgin wants to say, oh, that borrower, he saved it. And I want to say, okay, this is the last point I'll make, folks. Just bear with me here, but it's important. If you want to say that guy is making a loan to the bank by holding on to the notes, okay. But notice what else happened in that transaction. He borrowed from the bank too, right? Right. In terms of the balance sheet, yes, the bank, its liabilities went up by 100 ounces by him granting him those bank notes. And that's the thing Selgin wants to point to say, see, you're granting credit to the bank when you hold their notes. Okay, but by the same token, in that very transaction, the bank's assets went up by market value of 100 ounces too, when that guy signed the IOU. Okay, and so just in terms of man on the street, common sense, the guy started out with nothing. He walks into the bank, he signs an IOU saying, I'm borrowing 100 from you at 3% interest. The bank prints up 100 notes, hands it to him. The guy walks out of the bank. And I believe the way Selgin would explain that is that guy just made a loan of 100 ounces to the banker. And that explains why the fact that interest rates definitely went down for that to happen is correct, because now there's been more saving in the community. And I just want to say there's no way you can make that work. In the aggregate, there has not been more saving in the community. Okay. I will stop there.